Something strange is happening in the markets right now. The wars are still going, the debt is still growing, the dollar is still weakening, and yet gold dropped, silver got crushed. Why? Every single signal set up, but the market setting down. Is the story over? Is the bull run finished? Or is this the most dangerous trap ever set for the investors who blink first? What happens next? And will either make serious investors very wealthy, or leave the rest watching from the sidelines forever. Welcome back, everyone, and if you are joining for the very first time, welcome to John AG. Now, before we go any further, a quick word to those of you who have not yet subscribed to this channel. Think of it this way. You know that wise old friend, the one you call before making any big financial decision, the one who always seems to know something everyone else missed. Well, this channel is trying to be exactly that for you. And just like you would never ignore a call from that trusted friend, please do not ignore that little subscribe button. It costs nothing. It takes 1 second, and it might just be the smartest financial move you make today. Go ahead. Your future self will thank you. Also, before we dive in, drop a comment right now and tell the world where you are watching from. Whether you are sitting in New York, London, Karak, Dubai, or somewhere in between, let everyone know. This community is global, and every single location matters. There are moments in financial markets that stop even the most experienced investors dead in their tracks. Moments where everything they have studied, everything they have prepared for, and everything they believe about how money works suddenly appears to be completely wrong. This is one of those moments, and the investors who survive it and even prosper from it will be the ones who refuse to let confusion become panic. Here's what the world looked like in the final week of March 2025. Geopolitical tension was not fading, it was intensifying. Oil prices remained elevated, feeding inflation fears that central banks had been trying to contain for years. Long-dated government bond yields in the United States were pressing dangerously close to levels that make serious economists uncomfortable. Confidence in paper-based financial systems was not rebuilding. It was quietly eroding. The way old foundations crack before anyone notices the ceiling is moving. By every traditional measure, gold and silver should have been flying. That is not an opinion, and that is simply how these markets have historically behaved when the combination of war risk, debt pressure, and currency stress reaches a certain threshold. Precious metals have for centuries functioned as the financial world's emergency response system. When the sirens go off, people reach for them. And yet something went wrong, or at least it appeared to go wrong. Gold rolled over. Silver was hit even harder. The kind of selling that arrived in those sessions was not gentle or gradual. It was sharp, aggressive, and deeply unsettling for anyone who had positioned themselves for what seemed like an obvious move upward. Screens turned red, portfolios contracted, and in kitchens, in offices, and in late-night investment forums around the world, the same question began echoing from investor to investor. What just happened? The honest answer is that most people were asking the wrong question entirely. They were staring at the price and calling it the story. But price, especially in the short term, is one of the least reliable narrators in any financial market. It reflects positioning, pressure, and mechanics just as much as it reflects fundamental value. And in this particular moment, what the price was actually showing had far more to do with who was being forced to sell than with what gold and silver are actually worth. This is a critical distinction, and it is one that separates informed investors from reactive ones. When a market becomes crowded, when too many funds, too many leveraged positions, and too many momentum traders pile into the same trade, it becomes structurally fragile. Not because the underlying thesis is wrong, but because the trade itself has become unstable. And when instability reaches a tipping point, it does not unwind politely. It unwinds violently. Funds begin liquidating not what they want to sell, but what they can sell. Assets with the largest prior gains become the first source of emergency cash. And precious metals, which had been among the strongest performers in the preceding months, became exactly that, a source of liquidity in a moment when liquidity was desperately needed elsewhere. This is not a conspiracy. This is not manipulation in the cartoon sense that floods social media every time gold dips. This is mechanics. This is how leveraged financial systems breathe and sometimes how they choke. What matters most and what the serious investor must hold on to right now is this single non-negotiable truth. A falling price and a broken thesis are not the same thing. They can look identical from the outside. They feel the same emotionally, but they are fundamentally different in meaning, in implication, and in the response they deserve. The warning here is not that gold and silver are finished. The warning is far more important than that. The warning is this, that the investors who cannot tell the difference between a shaken market and a broken one are the most dangerous threat to their own financial future. And that conversation is only just beginning. There is an old saying among experienced market watchers. They say that the most dangerous economic fires are not the ones burning in plain sight. They are the ones that go underground, the ones that disappear from the headlines, the ones that stop making noise but never actually stop burning. And right now, in the spring of 2025, that is precisely the kind of fire the global economy is sitting on top of. Because here is what did not happen when gold and silver pulled back. The debt did not shrink. The deficits did not close. The inflation threat did not quietly pack its bags and leave. None of the fundamental pressures that built the case for precious metals over the past several years simply vanished because a price chart moved in the wrong direction for a few sessions. That is not how macro pressure works. That is not how deeply embedded economic stress resolves itself. It doesn't. Not quickly, not cleanly, and almost never without consequence. Look at what the bond market was telling the world at this exact moment. Long-dated United States Treasury yields were pressing dangerously close to the 5% level. That number carries enormous weight, not just as a figure on a screen, but as a signal. When the world's so-called safest borrowing rate holds at that altitude, it means the market is demanding serious compensation for the risk of lending money to the most powerful government on earth. That is not a sign of confidence. That is a sign of quiet building concern. And it did not stop there. Mortgage rates in the United States climbed back above 6.25% for millions of ordinary families. That number is not abstract. It is the difference between being able to afford a home and being permanently locked out of one. It is the difference between refinancing old debt at a manageable rate and being trapped inside a financial arrangement that slowly tightens over years. When housing becomes this expensive to finance, the real economy does not simply shrug and move forward. It slows, it strains. It begins sending distress signals through consumer spending, through business investment, and through the general confidence that keeps economic activity moving in a healthy direction. Then there is energy. Oil prices remained at levels that kept inflation risk very much alive. This matters because energy is not just one item on a list of economic variables. Energy is the bloodstream of the entire industrial world. When energy costs stay elevated, they feed into the price of almost everything else. Transportation, manufacturing, food production, logistics. The inflation that central banks spent years trying to defeat does not fully retreat when oil stays high. It waits. It finds new pathways. It resurfaces in places people stopped watching. And perhaps most importantly, the narrative that had given financial markets such comfort for so long. The idea that interest rate cuts were just around the corner, that relief was coming, that the pressure would soon ease, that narrative was being forcibly dismantled in real time. The market had to confront a new and far less comfortable reality. Rates were not coming down quickly. The era of cheap money was not returning on any near-term schedule that serious analysts could defend with honest data. This is what the word higher for longer actually means when it moves from a phrase on a financial news ticker into the lived reality of businesses, households, and investment portfolios. It means cost structures that do not shrink. It means margins that compress. It means risk appetites that contract. And it means that the fundamental conditions which make hard assets, real, tangible, finite assets like gold and silver, relevant and necessary, remained firmly, stubbornly in place. The fire never went out. It simply went quiet enough for people to stop watching the smoke. There is no other asset in the entire financial world quite like silver, not one, because silver does something that no other market does with such ruthless consistency. It makes intelligent people feel completely foolish right before it proves them completely right. It is the one market that will take a careful, well-researched, fundamentally sound investment thesis muso and punish it so aggressively in the short term that even the strongest conviction begins to crack under the pressure. And then without warning, without apology, and without giving anyone enough time to properly prepare, it moves violently, decisively, and the people who held on quietly collect what the people who panicked left behind. That is not poetry. That is the documented behavioral history of this metal across decades of market cycles. So when silver got hit hard in the final days of March 2025, the noise was immediate and predictable. Social media filled with declarations that the story was finished. Forums that had spent months celebrating silver's rise suddenly shifted tone entirely. The word collapse appeared in headlines. The word manipulation appeared in comment sections. And somewhere in between all of that noise, the actual story, the one built on physical data, supply chain reality, and structural market fundamentals, was being completely drowned out by the sound of short-term emotion, doing what short-term emotion always does, making permanent decisions out of temporary information. Here's what the data was actually saying beneath the surface of all that noise. Registered silver inventory on the primary United States Futures Exchange was sitting in the mid-70 million ounce range at that point in time. For anyone unfamiliar with how futures markets operate, registered inventory refers to the silver that is specifically available and ready for physical delivery against futures contracts. It is the cushion. It is the buffer between paper promises and real metal. And that cushion, by any historical standard, was not generous. It was not the picture of abundance that a market facing heavy industrial demand, rising investment interest, and consecutive years of supply shortfalls should ideally carry, because that is the part of the silver story that price volatility has a habit of obscuring, the supply deficit reality, not the version that circulates in dramatic online videos about empty warehouses and imminent systemic collapse, but the measured, verifiable, institutionally documented version. The version where credible industry projections pointed to 2025 being the sixth consecutive year in which the world consumed more silver than it produced. 6 straight years. That is not a temporary imbalance. That is a structural condition building pressure the way water builds behind a dam, quietly and visibly, and with consequences that eventually cannot be ignored, regardless of what the paper market is doing on any given Thursday afternoon. Industrial demand was not softening either. Silver's role in solar panel manufacturing, in electronics, in medical technology, and in the expanding infrastructure of electrification meant that the demand side of this equation was being supported by forces that had nothing to do with investor sentiment and everything to do with the direction the physical world was moving. These were not speculative buyers who could change their minds overnight. These were industrial users with long-term contracts, production schedules, and supply chain commitments that required real metal, not financial instruments. And then there was the retail signal, quiet but significant. In moments when spot prices were being pushed lower by futures market pressure, physical coin premiums were not collapsing in the same direction. They were holding. In some cases, they were rising. The person buying actual silver ounces. The individual walking into a coin dealer or placing an order for physical product was not behaving the way the futures screen suggested they should. They were stepping forward while leveraged traders stepped back. That gap between paper behavior and physical behavior is not decoration. In every serious commodity cycle, it has been one of the earliest and most reliable indicators that something structurally important is building underneath the surface noise. Silver was not broken. Silver was simply being silver, which means it was setting the stage for what comes next. History has a pattern, and the pattern is uncomfortable because, almost without exception, the moments that later get identified as the greatest entry points in any major financial market are the exact same moments that felt the most terrifying while they were happening. The moments when headlines were darkest, when confidence was lowest, when the people who had been right about the big picture were being loudest in their doubts, when every short-term signal was screaming danger, while every long-term fundamental was quietly, patiently building the foundation for something significant. This is one of those moments, and the great news hidden inside this warning is not complicated. It simply requires the discipline to look past the noise long enough to see it clearly. What violent pullbacks in fundamentally sound markets almost always reveal is not weakness in the underlying thesis. They reveal the final stages of positioning cleanup. They are the market's way of shaking out the weak hands, the over-leveraged latecomers, and the momentum traders who were never in for the right reasons to begin with. When that cleanup happens aggressively, when the selling feels disproportionate, when prices drop harder than any fundamental justification can explain, it is frequently because the paper side of the market is under maximum mechanical stress. And maximum mechanical stress in markets with genuine physical demand underneath them has historically been one of the most reliable setups for what comes after. What comes after is the reversal. Not always immediately, not always on a schedule that satisfies impatience, but with a consistency that the serious long-term investor learns to recognize and quietly respect. Look at what was sitting in plain sight at this exact moment in time. The bond market remained fragile. Housing affordability had deteriorated to levels that entire generations of younger buyers could not overcome without dramatic changes in the rate environment. Energy costs kept the inflation story alive. Central banks around the world, particularly in the East, had not stopped accumulating gold. That accumulation had been running quietly, consistently, and at historically significant volumes for years. These were not retail investors reacting to a YouTube video. These were sovereign institutions making multi-dead strategic decisions about what they wanted sitting inside their reserves when the next major global financial disruption arrived. That signal alone deserves serious weight, because when the largest and most patient pools of capital on Earth are moving in one direction, not loudly, not dramatically, but steadily, and with unmistakable purpose, the thoughtful investor pays attention, not because following is a strategy, but because understanding why they are moving reveals something important about where the weight of global financial reality is actually shifting. The fragmentation of price discovery that was becoming visible in this period was equally important. Futures markets moving one way, physical premiums holding or rising, regional demand flows sending signals that contradicted what the screen was showing. Industrial users locked into procurement schedules regardless of short-term price swings. These are not the characteristics of a market whose story is finished. These are the characteristics of a market whose most important chapter has not yet been written. And that is the great news. Not that everything is easy, not that the path forward is smooth or perfectly predictable, but that the conditions which created this opportunity, the debt, the deficits, the rate pressure, the currency stress, the